every hotel bankruptcy in the history of American hospitality finance has a specific trigger, not a general cause, not a broad market condition. A specific contractual provision in a specific loan document that was breached on a specific date, producing a specific sequence of legal events that ended with a Chapter 11 filing, or a foreclosure action, or a deed in lieu transaction, whose public record documents the precise moment at which the hotel's financial architecture failed. This episode is different from every previous case file in this channel's archive. Every previous case file has examined a specific hotel, a specific building, a specific institutional failure with a specific name attached to it. This episode examines the mechanism itself, the specific anatomy of how hotel bankruptcies happen, in a format that allows the analytical framework this channel has applied across 60 case files to be examined as a system rather than as a collection of individual cases. The mechanism has 4 components. The first is the debt covenant, the specific contractual condition embedded in the loan document that defines the financial performance threshold, whose breach triggers the lender's enforcement rights. The second is the RevPAR trajectory, the revenue per available room metric, whose movement documents the hotel's competitive position relative to the market, and whose decline below the debt service coverage ratio's implied minimum is the specific financial condition that debt covenants are designed to detect and respond to. The third is the covenant breach, the specific moment at which the hotel's financial performance falls below the contractual threshold, activating the lender's right to demand immediate repayment, accelerate the loan maturity, or initiate foreclosure proceedings. The fourth is the institutional response, the specific sequence of negotiations, forbearance agreements, covenant waivers, and restructuring proposals that the borrower and lender engage in between the covenant breach and the eventual resolution, whether through restructured debt, asset sale, or bankruptcy filing. Understanding this mechanism in its generic form allows every specific case this channel has documented to be read as an instance of the same pattern, and allows the pattern's recurrence across 60 case files to be understood as the product of structural features of the hotel finance market rather than as a series of individual management failures. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The debt covenant in a hotel construction or acquisition financing is the contractual mechanism through which the lender converts the loan's financial risk into a legal right, whose exercise is triggered by the borrower's financial performance. The most common covenant structure in hotel financing is the debt service coverage ratio requirement, a minimum ratio of net operating income to total debt service that the property must maintain across each measurement period, typically annual or trailing 12 months, as a condition of the loan remaining in good standing. A debt service coverage ratio covenant of 1.25x, for example, requires the hotel to generate net operating income equal to at least 1.25 times its total principal and interest payments in any given period. The 0.25x cushion above the break-even coverage represents the lender's assessment of the minimum financial cushion required to maintain confidence that the loan will continue to be serviced through moderate operational volatility. The covenant threshold is calibrated at origination to the hotel's projected stabilized performance, with the cushion sized to the expected range of performance volatility for the property's market position, competitive set, and customer base. The specific vulnerability embedded in this structure is the one that this channel has documented across every case file examining over-leveraged hotel acquisitions. The covenant threshold calibrated to stabilized performance projections that assumed a specific RevPAR trajectory in a market that subsequently produced a RevPAR trajectory below that projection. RevPAR, revenue per available room, is the product of average daily rate and occupancy rate. A hotel whose RevPAR is declining is either losing rate, losing occupancy, or both simultaneously. The covenant that the hotel's lenders did not read carefully enough was the one embedded in the relationship between the RevPAR trajectory the acquisition financing had assumed and the RevPAR trajectory that the competitive market would actually produce. When RevPAR falls below the level implied by the debt service coverage ratio covenant, the covenant breach becomes inevitable unless the operator can reduce operating expenses faster than revenue is declining. A structural constraint whose difficulty increases as the decline accelerates and as the cuts required to maintain coverage approach the operational minimums that maintaining the hotel's competitive position requires. At what point does a hotel operator's pursuit of RevPAR at the expense of margin management create a financial structure more vulnerable to covenant breach than the debt service coverage ratio the origination appraisal projected? Leave your analysis in the comments below. The appraisal that produces the debt service coverage ratio covenant at loan origination is the foundational document in the anatomy of a hotel bankruptcy, because it is the document that establishes the financial performance standard, whose breach the covenant is designed to detect, and whose failure the subsequent proceedings will document. The standard hotel appraisal methodology projects stabilized net operating income on the basis of three inputs: the market's RevPAR trajectory, the property's position within its competitive set, and the operating expense structure that the hotel's management and physical characteristics make achievable. Each of those inputs has a range of plausible values, and the appraisal's stabilized income projection reflects the appraiser's judgment about where within those ranges the hotel's actual performance will fall. The appraisal failure documented across this channel's archive is consistent across case types and market cycles. The systematic treatment of optimistic values within each input range as the appropriate basis for the stabilized income projection. Driven by the incentive structure that rewards deal completion over analytical accuracy, the lender retains the appraiser. The lender's goal is deal completion. The appraiser who consistently produces appraisals that support deal completion at the lender's target loan amount receives more business than the appraiser who consistently identifies RevPAR trajectory uncertainties that reduce the loan amount or prevent the deal from closing. That incentive structure produces the systematic optimism bias documented in hotel appraisals across the market cycle. An optimism bias that is most visible in retrospect when the actual RevPAR trajectory is compared to the stabilized projection in the origination appraisal, and the gap between the two is the gap that the covenant breach eventually documents. The appraisal is not false at the moment it is produced. It represents the appraiser's genuine assessment of the most likely stabilized performance scenario. It is false in the way that every forward-looking financial projection is potentially false. It reflects the information available at origination, rather than the information that will be available when the stabilized performance period actually arrives. And it reflects the incentive structure of the party who commissioned it, rather than the independent assessment that the party whose money funds the loan would prefer. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The covenant breach is the precise moment at which the hotel's financial architecture transitions from a functioning debt service machine to a legal dispute between a borrower seeking forbearance and a lender calculating whether enforcement or negotiation produces the better recovery. That moment is rarely as dramatic as the term breach implies. In most hotel bankruptcies, the covenant breach occurs months before the borrower acknowledges it and years before the lender enforces it, because both parties have institutional incentives to defer the formal acknowledgement of a financial reality that enforcement would require them to address. The borrower defers because acknowledgement triggers the lender's enforcement rights and begins the public record of the financial failure that affects the borrower's relationships across every other financing in their portfolio. The lender defers because enforcement requires marking the loan to its recovery value, a process that in a declining hotel market produces a write-down that the lender's balance sheet absorbs and whose magnitude depends on the market conditions at the time of enforcement rather than at the time of the breach. The forbearance agreement is the institutional mechanism through which both parties defer the formal acknowledgement. The lender agrees not to exercise its enforcement rights for a specified period in exchange for the borrower's commitment to specific remedial actions, financial reporting requirements, and in many cases, a fee that compensates the lender for the forbearance risk. The forbearance period is the interval between the covenant breach's occurrence and the hotel bankruptcy's formal initiation. And it is the period during which the institutional denial documented in this channel's archive is most precisely located. The borrower's sustained assertion that the RevPAR trajectory will recover, the lender's sustained willingness to accept that assertion as a basis for continued forbearance, and the accumulation of operating losses and deferred capital investment that each forbearance extension enables. The specific moment at which the forbearance cycle ends and the formal resolution begins is determined not by the financial reality, which has been clear since the covenant breach, but by the lender's assessment of whether continued forbearance or immediate enforcement produces the better recovery under the market conditions at the moment the decision is made. The resolution of a hotel bankruptcy, whether through restructured debt, asset sale, or liquidation, documents the final measurement of the gap between the appraisal's stabilized income projection and the hotel's actual performance, expressed as the difference between the loan's face value and the recovery the lender achieves through the resolution. That gap is the forensic measurement of the appraisal failure, the covenant breach severity, and the value destroyed by the forbearance cycle. The accumulated cost of optimistic projection, deferred acknowledgement, and prolonged institutional denial expressed as a specific dollar amount in a specific transaction document. Across this channel's archive of case files, that measurement has ranged from a relatively modest gap, as in the cases where the asset's genuine quality allowed substantial recovery at sale, to a catastrophic gap, as in the cases where the forbearance cycle's extension allowed the asset's competitive position to deteriorate to the point where the recovery reflected the market's assessment of a distressed property requiring significant renovation investment. The anatomy of a hotel bankruptcy is therefore not a unique or unpredictable sequence of events. It is a standardized institutional pattern whose components, the debt covenant, the RevPAR trajectory, the covenant breach, and the forbearance cycle, are present in every hotel financial failure, and whose outcome is determined by the severity of the optimism bias in the origination appraisal, the speed and depth of the RevPAR decline, the quality of the asset's underlying competitive position, and the market conditions at the moment the forbearance cycle ends. What this analytical episode reveals in the context of this channel's 60-case archive is the structural continuity that connects the Fontainebleau's construction loan default to the Caesars Entertainment LBO, to the Stuyvesant Town foreclosure, to the Las Vegas Monorail's ridership shortfall. Each of those cases is an instance of the same mechanism, expressed in different asset types and market contexts, driven by the same combination of optimistic projection, covenant breach, institutional denial, and eventual resolution. The mechanism does not change. The assets change. The markets change. The management teams change. The anatomy is the same. If this case file changed how you evaluate hotel financial distress, subscribe, because the next episode applies this framework directly to a specific acquisition pattern. And in the comments, across the 60 case files this channel has documented, which single analytical episode most precisely illuminates the anatomy of hotel bankruptcy, and why. The case file is open. This content was developed using artificial intelligence tools as part of the research, writing, and production process. All AI-generated material was subject to human review, editorial intervention, and approval before publication. Factual claims, interpretive framing, creative direction, and final content decisions reflect human judgment throughout. This disclosure is provided in accordance with platform transparency standards for AI-assisted content.